Look at the latest news and the charts for Plug Power. Ticker symbol PLUG. It's got a falling trend, flashing sell signals, and a massive wall of resistance just looming overhead.
Oh, absolutely massive.
Right. But then you flip over to the valuation models, and they're practically screaming that the stock is deeply undervalued. So what is it? I mean, are we looking at a coiled spring ready for a massive short squeeze? Or is this just a classic value trap waiting to crush retail traders?
That is the exact question we're answering today.
Exactly. Welcome to today's deep dive, everyone. Before we unpack all this, make sure to like this video, subscribe to our YouTube channel, and leave your feedback in the comments. Seriously, it's compulsory if you want to keep getting these insights from us.
Yeah, please do. And just to establish our golden rule before we jump in, we are looking strictly at the data, the SEC filings, and the charts. This is an objective, human debate and analysis of the numbers. It is absolutely not financial advice.
Always have to get that out of the way. So, setting the 30,000-foot view as of today, April 15th, 2026, PLUG is trading at $2.93. It's down slightly, about 1/3% today.
Right, which is pretty quiet compared to its history.
Oh, exactly. Over the last year, this stock has had a truly wild ride. It hit a 52-week low of just 69 cents and went all the way up to a high of $4.58. So how does a stock bounce between under $1 and almost $5 in a single year? Let's open up the books.
Yeah, to understand those wild swings, we really have to look at the income statement because it tells this crazy Jekyll and Hyde story. It totally depends on whether you're looking at the annual summary or just the final quarter.
Let's start with the ugly part. I'll run through the 2025 annual data. Revenue was $709.92 million, which, sounds okay.
On the surface.
Right, but the net income was a brutal negative $1.63 billion. Gross margin sat at an abysmal negative 34.09%, with cash from operations draining negative $535.8 million.
That is a staggering amount of cash to just burn through in 12 months.
It really is. And the balance sheet shows total assets of $2.59 billion, but a net debt of $335 million. So that's the grim annual picture.
Yeah, and that negative 34% gross margin is the real killer there. I mean, it literally means they were losing money on every single unit they sold before even paying for corporate overhead.
But then we hit the Q4 plot twist. Q4 of 2025 comes around, and they hit a record high revenue of $225.2 million.
Which is a nice bump.
Yeah, but most importantly, they delivered the company's first ever positive gross margin at plus 2.4%. They also showed improved cash op utilization. Now, I should mention Q4 net income still showed a negative $1.69 billion loss, but the filings point out that was largely due to non-cash charges.
Right, which is an important distinction. Non-cash charges like asset impairments hit the books hard, but they don't actually drain the bank account that quarter.
True, but I've got to push back here. Celebrating a positive 2.4% gross margin when you have $1 billion net loss, that feels a bit like, I don't know, finding a $5 bill in the couch cushions while your house is burning down.
That's a great way to put it.
So with $1 billion net loss, is this positive gross margin actually worth celebrating, or is it just a distraction?
I get the skepticism, I really do. But you have to look at why operational profitability matters. Shifting from a negative to a positive gross margin, even just 2%, is a monumental psychological and structural pivot.
Really? Just 2%?
Yeah, because for a historically cash-burning company, it proves that at a unit level, the business can theoretically make money. They finally prove they don't lose cash simply by turning the machines on.
Okay, I see what you mean. And that fundamental tension between the massive historical losses and these recent Q4 operational improvements, that is exactly what's creating this highly volatile technical battleground on the stock chart.
Well, the chart is a total mess of contradictions right now.
It really is. Looking at the technical analysis and momentum, the trend is officially bullish neutral. That's because PLUG is trading above its 200-day simple moving average, which is 2.18, and its 50-day SMA, which is 2.21.
So the longer-term trend looks okay.
Right. However, short-term momentum shows real weakness. The RSI, that's the 14-day relative strength index, is way up at 75.38. That's overbought territory, which usually signals a pullback.
Yeah, the engine is redlining.
Exactly. And the MACD is at 0.12, signaling a minor sell or at least a momentum slowdown.
For you listening, think of that MACD signal like the stock taking its foot off the gas. It's still moving forward, but the acceleration is dropping fast.
And you can see that stalling when we look at the key levels in order flow. The battle lines are drawn. Support sits at 2.25 and 1.84, while heavy selling pressure is basically a massive wall of resistance is sitting right at that psychological $3 mark.
$3 is always a tough ceiling to crack for a stock like this.
And there's another wall up at 4.30. Looking at the order flow, buyers are really concentrating in the 2.25 to 2.50 range.
So everyone is just waiting for a dip to buy in, but nobody wants to cross that $3 line.
Exactly. And if we look at who's buying and selling on the inside, we get more mixed signals. The CEO, Jose Luis Crespo, initiated a planned purchase in December 2025.
Which is usually a bullish sign.
But then, the chief strategy officer, Benjamin Haycraft, executed planned sales of roughly $4.3 million in January 2026.
Wow, so the C-suite isn't even on the same page.
No, they're not. Meanwhile, short interest is incredibly high. We are talking 25.53% of the float. That's almost 340 million shares sold short.
That is a staggering amount of short interest.
Right, with 5.24 days to cover. So with an overbought RSI, heavy resistance at $3, and crazy downside volatility, aren't retail traders just walking into a trap if they buy the top here?
Well, it's dangerous, that's for sure.
Hmm.
High short interest can cause a violent short squeeze if positive news breaks. If it spikes above $3, shorts panic, buy to cover, and drive the price up even faster.
A classic squeeze.
Yeah, but there's a huge catch. If the stock fails to break that $3 wall, the short-term technicals suggest it could easily slide into a falling channel. And that's how retail buyers end up holding the bag.
They get trapped at the top.
Exactly. They buy, hoping for the squeeze, the resistance holds, and suddenly the price is sliding back down to $225.
Because the technical charts are flashing both overbought and short squeeze potential at the same time, the true direction really relies on what analysts think the company is actually worth.
And spoiler alert, the analysts don't agree either.
Not at all. The consensus rating right now is a hold with an average target of 2.83. The breakdown is super divided. 20% strong buy, 50% hold, and 30% sell.
That is a perfectly split room.
It is. The valuation debate is basically two extremes. The overvalued camp points to a price-to-sales ratio of 3.74x. That is significantly higher than the industry average of 2.46x.
So it looks expensive relative to its peers.
Right. But then the undervalued camp points to discounted cash flow models, DCF models, that suggest an intrinsic value of 6.55.
Which would be a massive upside from 293.
Yeah, but here's the thing. That 6.55 valuation is based entirely on 2028 profitability targets.
Ah, there it is, the 2028 promise.
Exactly. Valuing a stock today based on 2028 profitability targets feels like someone promising to pay me back in 3 years, but they don't even have a job today. Aren't those models kind of ignoring the immediate danger?
You are hitting the nail on the head. That is the exact definition of the value trap argument.
Okay, expand on that.
So DCF models assume the company will actually survive to 2028 without severe financial distress. A stock looks cheap on a spreadsheet model, but the underlying liquidity risks mean the company might run out of cash before they ever realize that value.
So they go broke before they get rich.
Exactly. Or they dilute the stock so heavily to survive that your shares become practically worthless by the time 2028 rolls around.
Which brings us to the bull versus bear case outlook. Whether this is a value trap or deeply undervalued depends entirely on how the best case and worst case scenarios play out in the coming quarters.
Let's hear the bull case first. What's the best case recovery?
Well, the medium and long-term bulls are banking on a few things. First, that the new positive Q4 gross margins aren't a fluke.
Right, they need that to stick.
Second, there's a massive 3-gigawatt Australia deal in the pipeline. And third, the cost savings from their restructuring plan, which they're calling Project Quantum Leap.
Project Quantum Leap. Catchy name.
Very sci-fi. The ultimate goal of all this is reaching positive EBITDA by Q4 2026.
And for you listening, positive EBITDA just means their core operations are finally generating cash rather than burning it. If they hit that by late 2026, that's the holy grail for survival.
But then there's the bear case, the worst case continuation lower. The bears are pointing to ongoing liquidity risks, massive operational cash burn again, negative $535.8 million last year, and the risk of further shareholder dilution just to keep the lights on.
Dilution is the retail trader's worst nightmare.
But wait, I have to ask, if they have $2.59 billion in assets and only $335 million in net debt, why is liquidity suddenly the big bear argument?
That's a common point of confusion. You have to distinguish between illiquid physical assets and actual operational cash.
What do you mean?
Well, those assets are things like massive hydrogen plants, and specialized machinery. You can't just slice off a piece of a hydrogen electrolyzer to pay your employees on Friday, right?
Ah, okay. So it's wealth on paper, but you can't spend it at the grocery store.
Exactly. Liquidity is about the cash needed to pay the bills today. And that creates a stark difference in timelines for PLUG.
How so?
The short-term outlook, like the next few weeks, is all about surviving that $3 resistance and the overbought RSI without tapping out their cash reserves.
And the long term?
The long-term perspective entirely hinges on executing Project Quantum Leap so they can hit that positive EBITDA by late 2026.
Wow. Okay, so pulling this all together, we've got a natural human debate happening right in the middle of these SEC filings.
It's fascinating to watch play out.
PLGig is truly sitting on a knife's edge right now. On one hand, you're torn between a potential short squeeze fueled by operational improvements and big deals.
Right, the coiled spring.
And on the other hand, you have a severe retail value trap weighed down by heavy cash burn and this massive wall of resistance right at $3.
It really could go either way at this exact moment.
Which is why we dive into the data like this, so you can see the mechanics behind the chart. And just a reminder one last time, hit the like button, subscribe, and remember all of this was an educational exploration of the data, definitely not financial advice.
Do your own research. Always.
Always. But I want to leave you with a final provocative thought. If Project Quantum Leap is the bridge to 2028 profitability, but short sellers are sitting on 25% of the float today, who breaks first?
Oh, well, that's the million-dollar question.
Do the institutional shorts get squeezed out? Or do the company's cash reserves run dry before they can leap? Let us know what you think in the comments. We'll see you next time.